Now let's talk about the fun part. Why do we actually do it? Why is it so interesting to me that I'm willing to take up the risk? Okay. Now, why use margin on REITs? Simply, of course, you borrow money, there's a leverage impact. You increase the return. Okay. So numerically speaking, okay, let's say, for example, I got $10,000. I just buy REITs that give me 6% dividend. So obviously, my yield is 6%. Okay. But then assuming that this 10,000, I borrow 25,000, and let's assume that interest rate can be 3.5. Like I said, interest rate can change. Okay. This is how the mathematics works. Your dividend yield, instead of dividend of, what do you call it? 10,000, you're actually getting dividend from 35,000. Okay. Which means you get $2,100. Then, of course, you have to pay interest, this 3.5% on the 25,000. Okay. Your interest is 875. Your net dividend is 1,225. So can you see after leverage, I can get 12.25% yield. Quite short, right? Can you imagine you buy one REIT, you can get more than 10% yield. So in fact, that was somehow I was being persuaded by some bad friends of mine. Wow, 10% go and find. So today you can really find using margin. And let's say you use this number become 8%. Can you imagine? So some of the REITs now giving 8%. So you're going to do the mathematics. And in fact, now it's 2.8. It's not 3.5. Okay, you go and do the mathematics. The numbers can be very exciting. Okay. So again, like I said, from a wealth accumulation perspective, so what are some of the benefits? So now I'm actually going to talk about all the nice benefits first. So later I'll talk about all the risks. Okay, so if I become a dampener later, please don't scold me. So let's say, for example, you are someone who actually wants to build a portfolio faster. So this is the scenario whereby you actually do it without margin. So you invest 100,000. Okay, assuming that the price of REIT is $1, so you have 100,000 units. Stock value is 100,000. Every year you get 6,000. Okay, so assume that this dividend you will reinvest to buy REITs. Reinvest to buy REITs. 6,000 you plonk in. Okay, then same thing you buy another 6,000 unit of REITs. Then your stock value becomes 106. Then your dividend 6% of this. Okay, 636, so on and so forth. So 10 years later, if you continue this exercise, dividend reinvest, and assuming that the price still remain at $1, okay, your stock value after 10 years is 16,000. Now, if you actually do it with margin, okay, so with 100,000, you immediately go and buy $350,000. Okay. Your dividend is actually $21,000. And this 21,000, you go and repay the interest. Okay. So you go and pay down the interest. You actually go and repay the loan. You actually repay 12,250. You look at the mathematics. Then, of course, if you continue, your dividend is always 21,000, assuming at 35,000, 350,000 worth of the stock value. Okay, you will repay more and more and more. Can you see? So up to 10 years later, when you actually borrowed 250, up to after 10 years, your borrowing actually become half of it. Okay, and assuming you sell off everything on that day, okay, it's actually 227. 227. So same thing, both 10 years. This one after 10 years, 168. This one after 10 years become 227. And the most important thing here is this, you actually lock in at the current price. Okay. So if let's say basically, if let's say the price of this REIT keep going up, of course the price of REIT can come down. Okay. But let's say if the price of this REIT keep going up, okay, you are not even going to get 168. Because every year you buy is more and more expensive, every year you buy more expensive. So this one, you basically lock in the current price first. Okay, and then after that, you can technically leave it there and let you do your own magic. So it's very similar to like taking loan to buy a property. Like you think about it, so it's exactly the same as buying property for rental. And yes, we are still buying property. Just in this case, you are buying a basket of property for rental. Okay, then the rental income go and knock off your mortgage. So this is what people do when they actually buy property investment. It's like second property, like they just go and pay deposit, go and buy a second property, rent out, rental income, cover the mortgage. Basically, they also don't have any cash flow one. Usually those have loan don't have any cash flow. Then it's just that 20 years later, 25 years later, after they fully pay up the loan, right? The property become theirs. So it can be exactly the same thinking process as buying a property. So this is what has caught my interest when I actually do margin on REITs. By the way, the Excel spreadsheet which I sent to you, day one exercises, it have this 10-year repay scenario. Okay, this is the exact same scenario. I actually put in all the formulas there. Okay, as you can see, 6% of the stock value. Then interest is 0.35% of the borrowed amount. Okay, then after the repay, I put in here. So if let's say want to do any scenario analysis, right? Okay, play around with this spreadsheet. So I thought was actually quite useful to try to understand all this spreadsheet, play around. Then you have a better sense of the numbers. And of course, the magic in the numbers. Okay, I can't really put it in a word, but when I actually create all these spreadsheets, usually I see a lot more things. Okay, so it will be great if you can try to understand all the spreadsheets, which of course I will also go through as well. Okay, so this is one benefit, basically higher return, build a portfolio faster, you can lock in at the current price, assuming you believe that the REITs will actually keep going up. Okay. So investment can be a very creative process. Now, how do we actually generate returns from property investment? Okay, can I just get you all to contribute? There are actually 4 ways you can actually make money from property. In fact, a lot of people make money from property these 4 ways. What are the 4 ways people are making money from property? I'm quite sure by now people, okay, capital gain, thank you so much. What else? Rental yield, okay, thank you so much. Okay, these 2. Forced saving, thank you so much. And what is the third one? Or what's the last one? Leverage. Okay, thank you so much. So these are the 4 ways how a property investment can help people make money. Okay, so my point here is this. So in fact, margin on REITs exactly also use these 4 ways. Okay, so that's why now I'm actually not so keen to buy a second property. Initially, I was also very motivated. Well, come on, I teach people real estate investment. I myself never buy an investment property. But after I found this process, it's like, it's actually better. A lot of flexibility. I can start with smaller quantum. Okay, I can actually get better returns later, as you can see. Okay, of course, there's more risk. Why do I actually still want to lock into a second property? So in fact, that is what that caught me interested. Okay, now let me explain how does a property investment work. Let me explain how does a property investment work. Okay, a lot of people thought that property make money from capital gain. That is true. Okay, but in fact, a lot of people actually make money from the forced saving mechanism. Okay, forced saving mechanism. Okay, let me explain first. So let's say, for example, there's actually this property about $1 million. Okay, you put in $350,000, and then you borrow 650. Okay, you borrow for, let's say, 30 years, for example. Then interest rate, okay, let's say it's 2%. Of course, now it's about lower. If you do the mathematics, okay, the monthly mortgage will be about $2,004. Rental yield is actually 3%. Okay, 3% of this 1 million. That means every month about 2,005. Okay, very nicely, this 2,005 cover the mortgage. So you don't have to do anything. And 30 years later, okay, the property is yours. Okay, let me walk through with you this calculation. Will be great if you all can appreciate it. So like I said, it's very useful to understand some concept. So I've actually put in the formulas here. Okay, how does the property loan property system works? So let's say I buy a property 1 million, I borrow 650. Okay, I borrow for 30 years, interest rate 2%. So there's actually this PMT calculation. Okay, monthly payment calculation. Also, it's actually using the Excel function. So I actually put it here already. But you break it down, that's what happened. So month one, you actually borrow 650. Okay, this interest 1083, right? How is it being derived? It's actually basically 2% divided by 12 of this loan amount. Okay, every month, okay, you will repay 2403. Okay, so basically 2403, you minus off the interest, you minus off the repayment. Sorry, you minus off the interest, the rest of money go and pay down the loan. Okay, so end of the month, you actually get 648,681. Okay, this is only how much you owe the bank at after end of month one. Okay, in month two, okay, month two, of course, end of month one is 648,681. Month two is also 648,681. You can see that your interest actually lower because you owe the bank lesser. Okay, you still pay 2403 every month. That means you repay more. Okay, then you slowly reduce your loan amount. Okay, so this is what happened when you actually do a property loan. As you can see, 30 years later or 360 months later, very nicely you will fully pay the property. Okay, and of course, if let's say, for example, you rent this property out, this 2403, you actually get the rental of 2005. Okay, basically this 2403 won't be from pocket, it's from your tenant. Then what's going to happen? Your tenant will actually help you pay this payment. That means in a property investment scenario, you just put in the $350,000 for the next 30 years. No need to cash in. You don't get anything out. But 30 years later, you have the property fully paid. Okay, you have the property fully paid. Okay, so you actually make money from two ways in this example. So number one is this. So let's say, for example, 30 years later, the property price increase. Obviously, your price, you actually make money from capital gain. The next thing here is this. You actually created a wealth accumulation system. Okay, so basically what's going to happen? You actually save 2005 every month. Or put it this way, this is the amount you actually save every month. Okay, or either that your tenants help you to save. So your wealth is slowly accumulate. So this is what we call by a forced saving mechanism. Can you see? Because of loan, okay, you are forced to pay the loan. And then you actually get this amount being saved. Okay, think about it this way. So let's say, for example, this property, you don't take any loan. Okay, then you rent out, you get 2005 every month. Will you be so disciplined to save or invest in 2005? No, you may not. But because you actually take a loan, you are being forced to save this money slowly into your property. Now, why do I actually talk about this? Basically, margin on REITs work exactly on this concept. That's my point here. And that's why it's actually quite interesting to me. Work exactly like a second property. Okay, so if let's say I buy REITs, okay, instead of buying $1 million REITs, or buy $1 million property, I buy $1 million of REITs. Same thing, I put in 350,000. My loan 650. Okay, interest rate is higher. Obviously, let's say I use 2.5%, but my dividend yield is also higher. Okay, and dividend per month is 5,000. Let's look at the Excel spreadsheet. Okay, my dividend yield 6%, for example. So 6% of 1 million is 60,000 per year, 5,000 per month. Okay, and my interest is 3.5%. So this is my beginning loan amount. Okay, interest, how do I actually get this interest? 3.5% multiplied by this number divided by 12. Okay. Every month I get $5,000 worth of dividends, average speaking. So 5,000 minus this one, then the 3,000 I used to pay off my loan. Okay. So if you can see, again, you don't get to withdraw this dividend. Everything automate for you. And the good thing here is this, instead of 30 years, so after 164 months, which is about 13.7 years, okay, that $1 million is cleared off the loan already. Okay. Any questions on the calculation part? Anybody want me to reiterate any point?
Sorry, I mean, just to
yes.
check, your dividend per month, $5,000. How do you get that?
6% of 1 million.
6% of the loan amount.
No, 6% of the 1 million. You have 1 million of REITs, right? This 1 million REITs gives 6%, right? 6% of 1 million is 60,000. 60,000 divided by 12 is 5,000 per month.
Yeah, correct. Thank you very much.
Okay. Any other questions? Okay, if no questions, the main thing here, I want to actually again bring across, I know I'm repeating myself. Okay, when we do margin on REITs, what are we doing? We are building a wealth accumulation system. And this wealth accumulation system is exactly like buying an investment property. Whereby once you start it, okay, you can technically leave it there, and 20 or in this case 15 years later, okay, whatever you bought will be cleared off the loan. And that is the main thing I want to preach here. I don't use margin as trading. I use margin as a wealth accumulation system tool. Okay? If you are agreeable with this point, if you know what I'm trying to get at, don't mind just help me put a 1 into the chat. If you don't agree, if you have any comments, please feel free to share. Okay. Okay. Thank you so much. Okay. So this is what I mean by using margin as a wealth accumulation tool. Okay, great. Also, and of course, the good thing here is this, compared to a second property, number one, this is really not all my egg in one basket. If I have $1 million, right, I only can buy one property. If I buy $1 million worth of REITs, right, I easily buying, I don't know, 500 properties. It's really very diversified. Okay, that's one. Number two here is this, down here, the renter, you still have a little bit of stress. So let's say, for example, your tenant actually don't pay you cannot get rental you have to do a property management okay, this kind of thing. Down here, I totally don't have to do anything at all. Okay, as per what you've seen just now, once you actually put in, the money will automate. Okay, the third benefit here is this. Okay, this one is you have to one shot go in there. You have to buy 1 million. So what I'm actually doing now is I can slowly build up. Okay, so you will actually, I will share more with you the next week. Okay, when I talk about buying strategy. So even if let's say I have 300,000, I wouldn't buy one shot. I will slowly build up. Slowly buy. Or I can actually break it up to buy different REITs at different time. So in that sense, my risk from that perspective is a lot more controlled. So this is in fact why I'm so keen on doing margin on REITs. Oh yes, correct, Lang. You actually put it correctly. Additional risk is the fluctuation of stock market. You are totally correct. So that's why in the next week lesson, we already talk about how do you actually manage that. So personally now, okay, just to let the cat out of the bag, personally now I'm actually buying on the monthly basis. So even if I have 300,000, you won't see me tomorrow go and buy 300,000 at one shot. I'm actually buying on a monthly basis, slowly roll, okay? So that I will prevent that risk of the stock market fluctuation.
Sorry,
Yes.
just now you mentioned that the risk of buying a property is that, first of all, we have to find tenants.
Yes.
We have to worry about tenants' payment. We
Yes.
can only buy one property at that time. And what's the last risk that we have to remember?
Oh, I said so many things. Anyone can help? Oh, so okay, I can speed up lah. Sorry, I think it's the mainly is the three lah. Mainly is the three that you have actually mentioned lah.
Thank you.
Okay. Okay. So I actually want to share a quite an extreme example. What I actually want to do here is this: end of the day, investing can be a very creative process. So a lot is more than buy low, sell, buy low, sell. So if you with actually leverage, can a lot of creative process. So I just want to give one example. Of course, there are risks involved. Please don't after this immediately go implement. Okay, so there is involved. You have to ask yourself whether you can take the risk. Okay, but my point here is this: a lot of creativity. Hopefully, this one give you an example of how creative certain investors can be. Okay, so before I go to the exact example, I just want to share some numbers first. So let's say same thing, $1 million property. Okay, you put in cash of 300,000, you borrow 700,000. Okay, sorry. Okay, so let's say for example you have $600,000. Okay, you go and buy a $1 million property. Okay, 12,000, go and take a mortgage loan of 700,000. Then the other 12,000, okay, you go and invest in REITs, for example. Okay, so assuming that the monthly mortgage payment for this 700,000 is actually about here $3,000. If you without margin, okay, you have 12,000 cash left. Without margin, 6% of this 12,000, okay, is 18,000 or 1,500 per month. So if let's say, for example, you take this 1,500, go and pay your mortgage, you still have to find another 1,500, okay, to pay. But if let's say using margin, you can actually use this amount, okay, to actually pay off the mortgage. Then you don't have to find new money to actually go and pay. Now, what is the significance of this example? What is the significance of this example? I'm quite sure now a lot of you have heard this thing, buy one, sell, okay, sell one, buy two. Probably you all have heard this strategy there. A lot of property agents has been preaching, oh, you should sell your HDB property, then husband split, wife split, each one buy one. Okay. Instead of doing that, I have another quite interesting proposition here. Okay, again, I'm just giving an example of how creative can be. So let's say, for example, you have a HDB fully paid. Okay, today you go and sell, assuming your HDB can give you 600,000. Okay, you go and upgrade to a condo $1 million, for example. And because now you can actually borrow up to 75%, okay. So this 600, assuming you borrow 700,000, you only use $300,000 from here. The other $300,000, you can actually go and create a 1.5 million REITs portfolio. Okay. Can go and create a 1.5 million REITs portfolio. And the point I want to actually put across here is this. If you actually do that, you can actually able to upgrade to a new property without paying the mortgage. The mortgage payment will actually come off from the dividends from this 300,000. You all see the picture? So theoretically speaking, if let's say this is your case, 600,000, you upgrade to 1 million condo, okay? You put in $300,000. This 300,000, you're going to do margin on REITs, right? Okay. Then the dividend for margin on REITs just nice will cover the mortgage for this. So you have technically upgraded without a mortgage, without paying a monthly mortgage. So can you see how creative the mathematics can be? So if you understand my example just now, don't mind just put a 1. If let's say still not clear, maybe just put a 0. Okay, you don't get it, Okay. Okay, so the point I actually want to put across here is this. You can technically upgrade a condo, okay, without paying a money. Okay, now is you are staying in a condo, you're not renting it out. You cannot rent out. Okay, you are staying in a condo, that means there's no rental income. But if you actually do this exercise, you are able to upgrade to a condo without paying the mortgage. Okay, so what's that? So assuming you have 600,000, now you have 600,000. Okay, you sell. Okay, you go and buy a 1 million condo. So this $300,000 have to put as deposit. You go and loan 700,000. The other $300,000, you go and do this margin on REITs. Okay. So this 700,000 by right, you have to monthly pay $3,000. You have to monthly go and pay $3,000 to service a mortgage. But then if this one go into margin on REITs, right, the dividend can go and cover the mortgage loan for this. The dividend can go and cover the mortgage loan for this. Okay. Then net, you basically HDB upgrade to condo. You don't have to actually, you don't have to actually service the money mortgage. Okay, you still need to pay the money borrow on margin for it. Okay, later I share with you the mathematics. Okay, so Lang, give me a minute. I share the mathematics. Oh, no, Elaine, you got it wrong. So this 600,000 is assuming my HDB. Let's say now I stay HDB. I go and sell my HDB, I get 600,000. Okay, now I got $600,000 cash. I want to go and buy a $1 million condo. Okay, so if I buy a $1 million condo today, I can actually borrow up to 75%. Which means, okay, I can just borrow 700,000. Then the 300,000 I take from my 600,000, I actually go and pay down the condo. Then I got 300,000 cash left. Okay, so this $300,000, I go and do margin on REITs. And then, what do you call it? The dividend, I go and use it to service my mortgage. I don't have to pay anything already. Did I answer your question? Okay, the condo is 1 million. I pay 300,000. Okay. So now answer to Lang's question. Okay, maybe I show the mathematics again. That's why it would be great. Y'all can go and play around with the spreadsheet or try to understand a bit more. So I've done a spreadsheet here under service regular payment. Okay, so this is the exact scenario, right? Okay, this property, 1 million. I borrow 700,000. Okay, 25 years, 2%. Every month, I have to pay 3,000. Everyone have to pay. Okay, the other $300,000, I just plonk inside my margin account. Okay. Then after that, my loan 750. I actually go and buy a REITs portfolio 1050. Okay. I actually get a 6%. Okay. So you can see very nicely. Of course, this is, I didn't talk about REITs yet. Mathematically, it look perfect. So we actually talk about the REITs loan. Okay. The REITs, the beginning loan amount is 750, correct? Okay, I actually have a dividend about 5250 per month. 6% of this 5250. This 5250, I go and cover the payment for the mortgage 2967. The interest for REITs is actually 3.5 of 750. Okay, I can actually pay the interest. I still have $96 left. Okay, yes, after 25 years, okay, I still owe the REITs. The REITs are still on loan. Okay, the REITs still have 700,000 loan. Okay, but then for REITs is different. Okay, the REITs is you don't pay down your loan amount, it doesn't matter. So in that sense, my monthly outflow, nothing from REITs. Okay, Lang, have I answered your question? Okay, unlike property, property is no matter what, you have to pay 3,000. Okay, so for the REITs, this loan amount, okay, there is actually no requirement for you to say like, oh, every month must at least pay down how much. Don't have. So if every month you don't actually pay down the loan, totally okay. Or either that, I can give an example. Okay, like for example, in my case here, okay, if I want, I can actually do this. So let's say end of the month, I just instruct my remisier saying that, okay, end of the month, you just take my total dividend minus all the interest, the rest of all the money transfer out. I can do that, which means to say this loan amount don't reduce. Okay, it will always remain the same. Okay, Lang, did I answer your question? Okay, don't be shy. Feel free to ask if I'm not clear.
Yeah, I got it. Thanks.
Okay, thank you. Thank you so much. Okay. So, of course, please, the risk involved. Okay, I'm very scared when I do this part. I myself very excited when I talk about this. Okay, I'm trying to do something like that, but of course, there's a lot of risk involved. So, please remember disclaimer. So the end state is this. Let's say, for example, let's say I just stick to HDB. Assuming that all the assets increase by 3%. Let's say I just stick to HDB, 600,000, I don't do anything. Okay. So 25 years later, I got 1.3 million. So obviously I have no loan, total I make 1.3 million. But let's say I go to this exercise, I sell my HDB, 300,000, go and buy a new condo, 300,000, go and do margin on REITs. Okay. So my condo, assuming my condo increased by 3% per year, 25 years later, it comes 2.1 million. Okay. For my REITs, 1 million. And let's assume that REITs, of course, REITs price can increase. Don't forget, your REITs price also a capital can increase. So let's say my REITs also increase by 3%. Okay. After 25, it comes 2.2 million. Okay. So meanwhile, during the 25 years, right, the dividend from these REITs are used to pay off the mortgage. So 25 years later, okay, this one is fully paid. Obviously, down here, my loan is actually still not paid. So that means I still owe the broker several thousand. But if let's say my REITs become 2.2, I sell where the REITs pay off, I got 1.5 million. Then the exercise, I can almost triple compared to if I stay with HDB. Okay, so that is how creative investment can be, but very risky, very risky. Hopefully, I didn't open a can of worms, but yeah, every time I talk about it, I'm very excited myself. Okay, there's a question. I move already. Already move. Okay. Thanks. So from Serena, then is it more worthwhile not to pay down the principal? Okay, which principal, Serena? Maybe you want to unmute yourself. Which principal?
The one for the REITs margin. The 35,000.
So under this scenario,
no, is it under your actual Kiming one? That means I withdraw all the dividend every month minus the interest and then just keep the 35,000 loan, whatever.
So in terms of returns, then of course it depends on that dividend, how you actually use it to invest. If let's say, for example, that dividends, you go and invest of high return, of course it is. Like if you actually look carefully what I do, I actually keep rolling up. So my money has been very efficiently used. If you actually look carefully, so once I got money, right, I will go and buy REITs. Can you see here? So it won't be a case whereby, oh, I got 35,000, I stop. So as long as my margin allow, I will keep investing. So my portfolio get bigger and bigger. So in that sense, it's actually very efficiently used. Okay, and where does this money come from? From the dividend, you think about it. Okay, from the dividend. So in that sense, if you do what I do, then maybe you shouldn't be taking up. But of course, let's say you take out the money that is able to give you higher returns, then of course it's better. So it really depends on this dividend, how you use it. Hopefully I answer your question.
Thanks.
Yeah. Interest rate is expected to go up soon. What is your mitigation plan? Okay, Patrick, are you talking about this scenario? Are you talking about this scenario? That means, like, for example, my interest rate go up. Okay, interest rate for this one go up. For my loan go up. Are you talking about this scenario, Patrick? Or you want to unmute yourself? Maybe we can have a little chat. Okay. Yeah. So of course, all this is on paper lah. On paper, very nice. Okay. When we actually go to actual implementation, there are certain things you can tweak. Certain things you can tweak. So obviously, I won't be stretching myself to the limit. So you can think about it. Number one, if I will upgrade now, so basically my income actually alone, it can cover the mortgage already. Okay. Well, I just want to paint a scenario that even I don't want to use my cash income. Okay. If I can do this, okay, I can actually cover the mortgage. So of course, I cannot everything high risk. So basically my cash, like for example, this scenario, your cash income, you probably have to go for a lower risk, or at least have a buffer fund for things like this. If let's say interest rate go up and so on and so forth. So that have to be part of the package. Okay, I hope I answer your question. And of course, hopefully with interest rate go up, my dividend also go up. Yeah. Okay, but it's quite interesting. I still remember, I think in 2015, everybody has been talking about interest rate go up, interest rate go up. Then yes, in fact, in 2018, 2019, interest rate go up. But then after this COVID now, interest rates came down to very low again. So I'm not too sure when interest rate is going to go up. Okay, so hope I answer your question. Oh yes, it does. It does. Yeah, so you actually have to have buffer funds. That means cannot max out one, which I will talk about it very soon for the risk part. Okay. Again, so this one just to open up your creativity. A lot of people always think investment is I must buy something, I must hold something. So what the main point I want to say here is this. So sometimes a little creativity, of course, on paper, which theoretically is possible. You can actually almost 3 times. 3 times. So of course, everybody's scenario is different. Do we have a HDB now? Your HDB, does it really have 600,000? Blah, blah, blah. Everyone is actually different. Then have to adjust along the way. Okay. This example is just hopefully you can open up, be more exposed to some of the creative ideas in investment. That's all. Okay, so to summarize, so basically with margin on REITs, why we do it, with leverage, you get higher returns and you can actually create a forced saving mechanism, okay, because basically with the system that the broker set in place, your dividend is actually forced to pay down the loan. So in actual fact, you're paying down the REITs that you have bought as per what I actually shared just now. So this point is exactly what this diagram is showing you. Okay, so based on the design of the system, okay, this dividend is actually forced to pay down my loan. Okay, so unless I go and take out the money, which I could, but if not, by the design of it, they force down. So it's actually very good. It's actually an accumulation system for me. If I were to forget about this, then after that, 5 years later, 10 years later, I go back, it's actually going to be a nice surprise. Okay, that is what I mean by wealth accumulation system, which I sort of like automated. And what is the last point here? So you can actually use it to service a regular expense, then to be financially stress-free while acquiring a bigger assets. So basically your dividend, go and pay the mortgage, you upgrade it without having the stress of every month have to think of where is the 3,000 going to come from. So that are some of the benefits of margin on REITs.